Cross-border payments is one of the most complex topics in payments. I think one of the major problems lies in the way it is taught. I have an approach to make things really easy for you. You can learn cross-border payments and become an expert pretty quickly if you understand and adopt 4 strategies. The 4 strategies that we are going to discuss in the next minutes. If you understand these strategies, you will really stand out in the industry. So stay tuned. My name is John Paul. I'm a payments enthusiast and author of an acclaimed book about the SEPA credit transfer. I have over 16 years of experience in the payment industry and I'm still in love. Welcome to this 3rd video. In the first video, we considered the 7 reasons why you should join or stay in the payment industry. The second video was about basic concepts in payments. We defined payments, payment instruments, and payment systems. We looked at the generic structure of payment systems in any country. And then we considered the 4-corner model and looked at the customer-to-bank space and interbank space. In the final part, you are introduced to the LIMF method, a powerful method that you could apply to easily study any payment scheme anywhere in the world. If you did not watch the previous video, it will be a bit hard to understand the content of this one and connect the dots. So we encourage you to watch the video number 2 and then come back if you did not do it already. In the next minute, I will share with you the 4 key strategies to understand how cross-border payments work. After going through these strategies, you will see that cross-border payments are not as complex as you may think. So watch the video until the end to get all the pieces of the puzzle. Before looking at the 4 strategies, let's first answer this important question. What is a cross-border payment? How would you define it? Simply put, an international payment or cross-border payment is a transfer that must go through the border of the monetary zone where it is originated. It is an electronic fund transfer in a foreign currency or between 2 accounts located in different countries. Here, both destination and currency of the payment play an important role. The table you see here illustrates domestic and cross-border payments depending on the currency and the destination country of the transfer. We assume that the country where the transfer is originated is Australia, but you can take any other country or monetary zone. There are 4 quadrants. Quadrant 1 depicts domestic payments. If the currency of transfer is the national currency and the destination country of transfer is the same country, then it is a domestic payment. An example is a transfer in Australian dollar from Australia to a beneficiary in Australia. Except this quadrant, everything else is a cross-border payment, and we will see why. As you see in quadrant 2, if the currency of transfer is the national currency and the destination country of transfer is a foreign country, then it is a cross-border payment. With country, we refer to a monetary union or monetary zone, like the SEPA area, for example. So not only a geographical country. An example is a transfer in Australian dollar from Australia to a beneficiary in Germany, USA, or Brazil. Even if it is the local currency, the beneficiary is outside the country and the payment must cross the border and credit an account in a foreign country. The account located in the foreign country can be in any currency, Australian dollar, Canadian dollar, or euro. It doesn't matter. Quadrant 3 is interesting because we rarely think of it, but it does happen in reality. If the currency of transfer is a foreign currency and the destination country of transfer is the same country, then it is a cross-border payment. This sounds a bit weird, but the reason is that since the payment involves a foreign currency, a transfer must happen in that foreign country. An example is a transfer in US dollar from Australia to a beneficiary in Australia. That transfer must debit and credit accounts in the USA even if both parties are customers of two banks located in Australia. Finally, we have quadrant 4. If the currency of transfer is a foreign currency and the destination country of transfer is a foreign country, then it is a cross-border payment. An example is a transfer in euro or pound sterling from Australia to a beneficiary in Germany, USA, or Brazil. This is easy to understand, and many people believe this is the only case where the payment is a cross-border payment. But there are other cases, as we saw before. After this overview, we will now consider the 4 key strategies to understand how cross-border payments work. What you are going to learn can help you save precious time and even money, because many really struggle with it. What you will learn will empower you and set you apart in the industry. I will first provide an overview of the strategy, and then we will take a closer look at each of the strategies. The first strategy is understand the principles behind the organization of market infrastructures in the different countries. The second strategy, grasp the principles of correspondent banking and account relationships between banks located in different currency zones. This is the most important of the 4, as we will see later. The third strategy is the following: understand the role of the SWIFT network and the SWIFT standards. And finally, the strategy number 4 is study the basics of foreign exchange markets and how financial institutions, how the banks use them. When many begin with cross-border payments, they jump into the SWIFT messages right away. The messages are important, but after many years in the industry and many years teaching this, I now know that jumping into the messages is not the right approach. It is even counterproductive. So take the time to really understand these strategies before looking at SWIFT messages, and you will acquire cross-border payment skills faster. Let's consider the strategy number 1. Understand the principles behind the organization of market infrastructures in the different countries in the world. Cross-border payments involve 2 or more countries. If we can easily find out how market infrastructures are organized in any country in the world, then that will help us to understand what happens when an instruction reaches a foreign country. For that, we get back to a key tool that was introduced in the previous video, the generic model of payment systems in a country. This model can help you to analyze and study the payment market infrastructure of any country. In the previous video, we considered the payment systems in the United States and in France. This model was helpful in the analysis. In order to show you how important this model is, we will now consider the payment market infrastructures in Australia. As we see, once again, we have the central bank systems in the middle and the ancillary systems all around. In Australia, there is traditionally one large value or high value payment system. It is called RICS, for Reserve Bank Information and Transfer System. RICS is used by banks and other approved institutions to settle their obligation on a real-time cross-settlement basis. The Fast Settlement Service, or FSS, is the settlement component of NPP, the New Payments Platform. The New Payments Platform enables the processing and settlement of real-time payments in central bank money. It allows transactions to be settled individually on a 24/7 basis. The development of NPP is the major project of the last few years in Australia. NPP is an open access infrastructure for fast payments, a platform that should enable the rapid development of new services and foster innovation. The central bank had to upgrade its own system to support the new processor implemented in NPP. That is why the fast settlement service was set up. Another important payment system in Australia is the bulk electronic clearing system. It is used for the bulk processing and clearing of direct entry payments and direct debits. The settlement happens in REITs, the RTGS system. Checks are exchanged and cleared in the Australian Paper Clearing System, or ACPS. And without surprise, the settlement of checks happens in REITs, the RTGS system. BPay is a bill payment system used in Australia. It enables payments to be made through a financial institution's online, mobile, or telephone banking facility to organizations which are registered BPay billers. It is Australia's most widely used bill payment service, which enables bill payers to transfer funds electronically from their bank accounts to billers. It is offered as a payment channel by over 170 financial institutions through their phone and internet banking services. A similar service has been developed under the new payments platform. It is called OSCO by BPay. There are many card networks in Australia. Banks and financial institutions issue debit cards and credit cards supported by the International Card Scheme, Visa and MasterCard. Banks also issue debit cards supported by a domestic debit card scheme, the EFT Pulse Payments Australia. Charge cards are issued by American Express, Diners Club, GCB and other players. And finally, we have the continuous link settlement system that Australian banks use for the settlement of Australian dollar legs of foreign exchange transactions. Cross-border payments go through the SWIFT network or through international card networks. Domestic payments remain inside the big cycle you see here because they move from one bank to another in Australia. They don't need to cross the border, so to say. Each bank in Australia is identified with a BSB code. BSB stands for Bank, State, Branch. It is a set of 6 characters that identifies where a bank account is located in Australia. So it's a kind of national clearing code that must be provided in payment instructions. Now look at this simple but powerful model. If you work in the payment industry in Australia, or if you want to learn about market infrastructures for payments in Australia, then isn't it helpful to have such a model? I think you now see where I'm taking you. If it was not clear after the previous video, then it should be clear now. In any country, payment market infrastructure are organized almost in the same way. There are central bank systems and ancillary systems that banks join for the exchange, clearing, and settlement of payments transactions. Banks join the central bank systems and one or many ancillary systems. Ancillary systems are connected to the central bank system because the settlement of transactions ultimately happens in central bank systems. With this structure in mind, it is easy to see how domestic payments are cleared and settled in Australia and what may happen to a payment instruction that arrives in Australia from abroad. Now let's move to the second strategy. Grasp the principles of correspondent banking and account relationships between banks located in different currency zones. This is the most important of all the 4 strategies because at the end of the day, payments is about moving funds. And in cross-border transfers, funds move through correspondent accounts. So grasping the principles of correspondent banking and account relationships is essential. The basis, the foundation of correspondent banking is the account relationship. We can even say that the account relationship is the passport to access the payment systems of other countries. That will become very clear soon. Let us consider the payment systems of 2 countries. France and the United States. French banks have customers who want to transfer funds to the USA. For example, parents may need to pay the tuition of their girl who is studying at a university in the United States. And in the USA, there are people who want to transfer funds in euro. We can imagine a French company that is supplying a product or a service to a US company and wants the payment to be made in euro. There are other cases we can easily think of. We see that banks need to send and receive payments in foreign currency to serve the customers. But they can do it on their own behalf too. If a French bank wants to send or receive US dollars, then it needs to get access to the USA payment systems. And the same thing applies for US bank. If it wants to send or receive euro, then it needs to get access to the euro payment systems. Now the question is, how do banks access payment system of foreign countries? The answer is actually quite simple. They become customer of a bank located in a monetary zone that they want to have access to. A bank customer of another bank? This may sound weird for beginners, but that's what they do. Like individuals and corporations open bank accounts to send and receive funds, banks do the same to send and receive funds in foreign currency. They become customers of banks located in foreign countries. The account opened in the foreign country is called correspondent account. Here, the French bank 4 asked the US bank, the bank D, offering correspondent account services, to open an account. When the account is open, the French bank 4 becomes an end party for bank D, like companies or individuals that have an account with bank D. The French bank can now access the US payment systems through the account it has with bank D. The bank D may also open an account with the bank 4 in France, but it is not mandatory. Let us assume the French bank is BNP Paribas and the US bank is Citibank. When BNP Paribas opens an account with Citi, both banks enter into what is called a correspondent account relationship. The bank in the USA becomes the correspondent of the French bank in USD currency. Note that the account is open in the book of the bank in the United States, but it is the account of the French bank. If BNPP opens an account with Citibank, but Citibank does not open an account with BNPP, then both are in a unilateral account relationship. The relationship is unilateral because there is only one account opened. However, if each bank opens an account with the other, then they will enter into a bilateral account relationship. Before moving on, we need to clarify the differences between nostro, vostro, and loro accounts. In the same way that corporations can open accounts with several banks, a bank itself can open different accounts with many other banks. Those accounts are called nostro and vostro or loro accounts. The same accounts can be called nostro, vostro, or loro account. It depends on the relationship that a bank has with the account. To help you understand the difference between nostro account, vostro account, and loro account, we have added an additional bank on the picture. It can be any bank that is not part of the account relationship. BNPP has opened an account with Citi. Both BNPP and Citi are in an account relationship. BNPP will call that account its nostro account, and Citi will call the same account the vostro account of BNPP. As you see, we don't have two accounts, but only one. The same account is called nostro account by the account owning bank and vostro account by the account holding bank. Nostro is the Italian word for our, vostro is the Italian word for your, and loro the Italian word for their. The account belongs to BNPP since it has opened it. That is why BNPP call it nostro account. For BNPP employees, it is logically our account. Citi holds the account of BNPP. Therefore, Citi call it Vostro account. For Citi employees, it is logically your account. If we now consider banks that are not part of the account relationship, they call the account loro account. Many people say loro and mean vostro. Be aware that to be strict, loro should be used by a bank when it is not part of the account relationship. To summarize, here are some tips to remember easily what a nostro or vostro account is. If you are working for a particular bank, that is your bank, the account of your bank, which is held by another bank, is the nostro account. That account is not in the books of your bank. The account of another bank held by your bank is the vostro account. That account is present in your own books. The accounts of other banks that are not present in your books are called loro accounts. As we saw, Citi opens the BNPP account. As a bank, BNPP may have thousands of entries on its account with Citi, and it needs to follow and manage the liquidity on the account. So here is what BNPP does. BNPP opens an account in its own book called the mirror account. The mirror account is there just to follow what is happening on the real account and manage the liquidity on the real account. The mirror account does not contain real money. Why is it called mirror account? Because the account entries on the real account and on the mirror account are of same amount but opposite signs. If the real account is debited, the mirror account is credited and vice versa. Real and mirror accounts are completely different accounts. The account numbers are different, as you can see on the picture. The money, however, is only on the real account. What you see on the mirror account are just numbers to follow what is happening on the real account. In some payment engine software, the mirror account is called nostro account instead of mirror nostro account. Please keep in mind that the nostro account is always in the books of the correspondent bank, never in your own books. In other words, a bank does not debit and credit its nostro account. Its correspondent bank does. Accounting entries on vostro and nostro accounts and their related mirror accounts are of same amount but opposite signs. The dates may not be the same simply because accounting entries are made on different dates and each bank may have own rules for the value date calculation. In any case, the amount should be the same but with opposite signs. In other words, if the sign is plus on the real account, then it should be minus on the mirror account and vice versa. Now, how to be sure that entries with the same amount relate to the same transaction? It is possible to have entries with the same amount that relate to different transactions. We all agree on that. So in order to be sure that entries are related to the same transaction, banks use references that are unique and enable to identify the transaction with certainty. As you see, the same reference is used on both sides. That unique reference, known by the two parties, is almost always used for reconciliation. And here we get to a key point. Both parties in an account relationship must agree on the reference to use for reconciliation. Otherwise, it will be very difficult for the account owner to follow what is happening on the account. In general, all entries on the mirror accounts are reflected on the real account. However, some entries on the real account may not be reflected on the mirror account. For example, when fees or other charges are taken by the correspondent bank. These entries are generally reconciled manually. Funds that BNPP has in currency are kept on the correspondent account. This is really a key point to understand as well. The bank obviously puts on money on its nostro account, but the bank also puts the funds of its customer who have accounts in the same currency on the same Nostro account. There is a key rule in cross-border payments which states the currency never leaves the country of origin. Customers in France can open an account in USD dollar with BNP Paribas. Then BNP will open accounts in its book for those customers. Each customer sees the amount of money in currency that is available on his account, and BNPP does the bookkeeping, but the funds are kept on the Nostro accounts of BNPP with Citi. For Citi, it is the money of BNPP, but in reality, BNPP has $500,000 of own money and there are $750,000 of customers' money, for example. Citi does not know how the $750,000 are distributed among the customers. That is the business of BNPP. Like individuals and companies, a bank may open many accounts in the same currency with the same bank or with different banks for practical reasons or other reasons. Which currency should be part of the correspondent network is determined, among others, by the type of currency. This ends our analysis of the second strategy. I already see a lot of smiling faces, and that's a good sign. It means I'm getting my job done. Let's move on with the third strategy. This strategy is about SWIFT. SWIFT stands for Society for Worldwide Interbank Financial Telecommunication. SWIFT plays a key role in payments in general and specifically in cross-border payments. Today, most cross-border payments are transported over their global network, SWIFTnet. Therefore, if we want to understand how cross-border payments work, it is worth taking a closer look at SWIFT. Before moving on, think about this. A bank is located in Europe and has an account with a bank in the US. How does the European bank send instructions to the US bank? And how does the US bank provide statement and other reporting to the European bank? In the past, banks were using letters, telegraph, phone, telex, fax. Remember I told you in the first video that payment rely heavily on telecommunication networks. But the problem with telegraph, telex, or fax is that they are unsecure, and fraudsters can easily take advantage of it, and they did. Another problem lied in the payment instructions that banks were sending to each other. They did not have the same structure and the same meaning for all the parties involved. So the banks were struggling with understanding each other. In other words, communication was difficult. SWIFT was created to address two problems in correspondent banking relationships: security of the message transport and automation for the message processing. The security challenge is met through its network called SWIFTnet, and the automation issue is addressed through standardization. On the picture, you see that the French bank and its correspondent in the USA are connected through SWIFTnet. They can exchange information without worrying about the security that is guaranteed by SWIFT. Furthermore, SWIFT has developed message standards to support the transmission of payment instruction in an harmonized way all over the world and improve the communication among its participants. SWIFT message standards are so widespread that they are sometimes used in other contexts outside the SWIFT networks. SWIFTnet is a highly secure network. It enables to carry financial messages in a highly secure way from one party to another over the network. Two topics are closely linked to the security of the SWIFT network: the public key infrastructure, or PKI, and the relationship management application, or RMA. SWIFT has set up a public key infrastructure since the early days to enable secure communication about its participants. All communication going through SWIFTnet is highly encrypted so that an external party cannot spy on the message or forge it. The public key infrastructure allows, among others, the management of digital certificates and public key encryptions for the member banks and corporations. Before exchanging financial messages, the parties must exchange the certificates or key, and that happens through the relationship management application. That application enables a receiver to specify which message types are permitted from a counterparty and to send the permission data to that counterparty. The sender can check the message type against the permission data before sending a message to a receiver. Furthermore, SWIFT has been using standards to enhance the communication amongst the participants since the beginning. The original message types, the SWIFT-MT, were developed by SWIFT, and a subset was retrospectively made into an ISO standard, the ISO 15022. With the time, it was becoming more and more difficult with the ISO 15022 to meet the new needs of the payment industry. Therefore, SWIFT developed the ISO 20022 standards. The SWIFT standards define the structure and meaning of messages, allowing banks and corporations to know what to expect in payment orders, reporting, and account information. I think we can see now why SWIFT is so crucial and why we should look at it closely if we want to understand how cross-border payments work. Let's move on to the last strategy. The strategy number 4 to understand how cross-border payments work is about the foreign exchange markets. Cross-border payments involve many countries or regions that use different currencies. So we need to study the basics of foreign exchange markets and how banks use them. In cross-border payments, incoming and outgoing payments often involve currency exchanges. Payment service users need to trade and convert their local currency into a foreign currency. Let us consider the following two situations. In the first one, there is a company in Germany that needs to pay an invoice to a company in the United States. And at the same time, we have a second situation where a company in the USA wants to pay an invoice to a company in Belgium. In the first situation, the US company wants to be paid in US dollar, but the German company's bank account is in euro. Since the German company does not have the US dollars, it must borrow USD in exchange of euro that it has to pay the US company. A currency exchange is therefore needed. The second situation is similar. The Belgian company wants to be paid in euro and the US company's bank accounts are in USD. The US company must therefore borrow euro in exchange of USD that it has to pay the Belgian company. A currency exchange is also needed, and it is exactly the opposite compared to the first situation. Both companies need to purchase foreign currencies in exchange of the local currency. Well, to do that, they can go to the FX markets directly or through their bank, because that is the place where supply and demand for foreign currencies meet. In other words, it is the place where currencies are traded. The banks in the different countries belong to the main players of the FX markets. So in addition to connecting to payment systems, major banks providing cross-border payment services need to build connections to FX market systems. They access the market to trade the currencies on behalf of their customers or for themselves. As we can see on the picture, banks also use the SWIFT network to transmit orders to the FX market in a faster and secure way. And here we meet SWIFT again, and this reminds us of the major role it plays in financial messaging. When a foreign currency is bought or sold, the correspondent account of the bank in that currency is debited or credited. And this is really a key point. Before a bank trades foreign currency, it must have a nostro account in that currency. It does not credit accounts in its own book with funds in foreign currency. That would correspond to putting money into a black hole. A key role in currency exchange deals is the following. A bank always buys at a lower rate and sells at a higher rate. In a currency pair, the bid or buy price is always on the left and the ask or sell price is always on the right. The Euro-US dollar rates presented here are from the dealer's perspective. In cross-border payments, the dealer is the bank. The bid rate is the rate at which the bank will buy USD against Euro, and the ask rate is the rate at which it will sell USD against Euro. Things are different for customers. They must apply the bid price when they sell the base currency and the ask price when they buy the base currency. So if you are in the Eurozone, for example, a base currency exporter will always look at the ask price, whereas a base currency importer will look at the bid price. We see that banks and customer transactions are always symmetrical. When the customer sells, the bank buys, and when the customer buys, the bank sells. Now, during the day, the bank receives and processes many instructions from its customers. There are customers who want to buy currencies, and there are customers who want to send currencies. Banks do not send orders to the forex market every time a customer instructs them to perform a transaction in foreign currency. That will be too costly and inefficient. Instead of that, banks collect all the FX instructions until a point in time and then looks at the FX account position to determine if they need to buy the foreign currency in case there is too little on the account, or if they need to sell it in case there is too much on the account. Liquidity management is therefore required to ensure that the bank does not have too much or too little funds in foreign currencies. For that purpose, positions are aggregated and followed in each foreign currency. The bank should forecast how much funds are needed in each currency in the near or further future. Liquidity management must also be performed to manage the foreign exchange risk. The bank should minimize and avoid loss due to variation of currency's rate. And for many banks, the FX risk is also an opportunity to increase the bank's profits on FX transactions. Now we get to this question: when do banks go to FX markets? Each transaction on the FX market incurs a cost for the bank, so the number of FX transactions should be as limited as possible. The bank usually defines amount threshold. It aggregates the currency amounts for low-value transactions and purchases the currency right away for high-value transactions. For transactions of small or limited amount, the bank collects all the FX instructions until a point in time. Adjustments are made on the FX account positions according to the type of transactions. Then the bank checks the FX account's position to determine if there is a need to buy the foreign currency or to sell it. Then a deal is made on the FX market if necessary. Banks have a different approach for transactions whose amount is above a certain threshold. Since the transaction amount is high, the bank may go to the FX market right away to make a deal and buy the currency. In that way, the bank limits its risk in case the exchange rate goes up. We are now through the 4 strategies. Now you understand the principles behind the organization of market infrastructures in any country. You are able to explain the principles of correspondent banking and account relationships between banks located in different currency zones. Many make it sound complicated, but it's actually quite simple. SWIFT networks and the SWIFT standards enable security and communication in cross-border payments, and you understand why it is so crucial. Finally, you know the basics of foreign exchange markets and how the banks use them. How do you feel after going through this video series? Many say to me, I feel empowered. I feel enlightened. I hope you feel the same. I'm happy I could share the basic concept of payments with you. When you understand the basics and principles, it's a real power. In a former assignment, I was working on 3 different projects involving 2 countries, 5 different payment schemes, and cross-border payments. Those key concepts were of great support and are still of great support. Just imagine how it will feel like if you will master this concept and if all your team members will master them as well. Just imagine the precious time you will save and what you could achieve. I hope you love the content we went through. If you want to receive the slides so that you can use them to explain the concept to others, use the link below the video to share it with other people that might be interested. To master payment and deliver payment projects, there are other things we need to know, as we will see in the next video. I've loved sharing these videos. I've loved creating these videos for you. We received so many great comments, so much feedback. It's so exciting for me to see everyone really getting this and how big of a deal this is, the impact it can make on your career and what it can do for your future. And this has just been fantastic sharing this. I've loved this process. I've loved this interaction we have had. I've loved getting all the comments from you. Now, in my next video, what I'm going to be sharing is how to go even deeper, because I'm going to be opening up a limited program. And I'm going to be taking a number of clients, a number of students that want to go deeper. And so I have created the Payment Mastering Program, which is basically the next step beyond this. So if you are ready to move forward, if you are ready to really get mastering payments and create new opportunities in your career, then I can't wait to share. I'm so excited to share this program I put together with amazing bonuses. And I will be sharing that with you in the next video. The registration period will be limited, so check out that next video right away in the next 3 days. Looking forward to seeing you again. Thank you very much for your attention.